Hi, Tesla is crashing. At least that's what the headlines want you to believe. The stock pulls back, deliveries are slow, margins come under pressure, and suddenly the internet is full of victory laps. The bears are celebrating, the shorts are back. Financial media is asking the same question again. Is this finally the end of Tesla? But there's one problem with that narrative. I've seen this movie before. And the last time it played out, people who bought the fear more than tripled their money. Every Tesla panic starts the exact same way. First, the stock goes down. Red candles take over the screen. And then media will pile on. There will be flash headlines about margins, deliveries, demand being low, competition is here, and uncertainty. The bears will celebrate. And then short sellers will start telling everyone this was only a car company all along. The headlines get louder and the emotions will get stronger, and the market becomes obsessed with short term numbers. Even after a strong delivery print, the stock sold off hard, and media outlets framed it as another Tesla reality check. Analysts talk about margins, CapEx, and whether patience was finally running out. But what if investors are staring at the wrong scorecard? Let's go back to early 2023. Tesla fell into the $100 range. Fear was everywhere. Analysts were downgrading the stock. Demand concerns dominated every conversation. Competition was supposedly coming from every direction. A lot of investors became convinced Tesla's best days were behind it. But then something remarkable happened. The people who kept their cool, the people who focused on the business instead of the fear, were eventually rewarded. That is why this chart matters. Tesla bottomed around 101. Today, the stock sits above 300. Investors willing to buy during peak fear more than triple their money. The point isn't the exact return. The point is what psychology looked like at the bottom. Because nobody felt confident buying Tesla at 101, that is why the opportunity exists. And I believe we are in a similar position today again. Now, compare today with that period. Different headlines, different numbers, same psychology. Back then, investors saw competition, margin, pressure, demand concerns, and uncertainty. Today, they are seeing almost exact same themes. The details may have changed, the emotions have not. This is where the story gets interesting. Because while investors argue about vehicle deliveries, Tesla is quietly building one of the largest manufacturing and AI ecosystems on the planet. And almost nobody is talking about it. Let's start with Gigafactory Texas Austin. Most investors look at it and see just another car factory. Tesla sees something completely different, the center of its next generation manufacturing strategy. Look at its capabilities: 4680s, battery cells, structural battery packs, future cybercab infrastructure, robotaxi deployment capabilities, and the future Tesla Optimus factory at a run rate of 10 million robots per year. This isn't maintenance spending. This is expansion investment at its best. Now zoom out globally. Shanghai, Berlin, Nevada, Fremont, all mega factories. What makes Tesla unique is not any single factory. It is the number of growth engines being built all at the same time. Most companies are pursuing one future. Tesla is pursuing several. This is where I think many bears make their biggest mistake. They are looking at quarterly scoreboards. Tesla is trying to build platforms. There's a difference. One side focuses on deliveries and the other focuses on autonomy. One side focuses on margin and the other focuses on building physical AI. One measures the present, the other is investing in the future. Even bullish voices on Wall Street are feeling the pressure of short term scoreboard. Dan Ives has been one of the Tesla's most consistent bulls, still talking about multi trillion opportunity in autonomy and robotics. But even he admitted on CNBC that investor patience is wearing thin and near term numbers do not match the long term story. Listen in.
Two mega cap tech stocks are getting trounced today. Both Alphabet and Tesla on pace for their worst day in more than a year and are dragging down the major averages. The reason here is that investors are just freaked out by their spending on AI.
Look, the reality. I mean, they're not a car company. When you think about it from an investor perspective, this is much more about AI, disruptive tech. And I think when you look at Tesla, look, the issue here continues to be, and same with Alphabet, CapEx investment for, let's say in Tesla, for physical AI, when it comes to autonomous, when it comes to Optimus, but you're not seeing in the near term, and that continues to be this gut check moment.
The stock is down more than 14%. Does this mean that investors just don't buy it?
I think patience is wearing thin, right? Because from an investor perspective, if you put up the CapEx numbers, but then you show it, they'll get benefit of the doubt. And I'd say Alphabet is a different story relative to the type of growth that they're showing on cloud. I think for Tesla, this is not just right around the corner. You have to ramp up Robotaxis. You have to show the physical AI story. Look, that's all that Musk is doing. And I think there is a view here, too, where with SpaceX, and now, of course, Tesla, Musk, the two golden childs that he has, where this ultimately heads. I just continue to view it that we are still in the third inning of AI revolution, and this is just the beginning of.
The numbers were strong, yet the stock sold off. A classic case of buy the rumor, sell the news. Plus, investors still wrestling with higher capex as Tesla leans in harder into AI, Optimus, and Cybercab. Isn't that the investment you want to invest in? The reaction of Wall Street is understandable, but it doesn't automatically mean the long term thesis is broken.
The AI story is the future. It's not about deliveries, but you have to ultimately build it out. You have to have more cities from Robotaxi. And Musk, on the conference call, I think there was definitely some caution, right? And I think maybe in some ways that's smart, but that's why the stock's reacting accordingly.
Tesla currently has three major opportunities approaching maturity: autonomy, energy, and robotics. Individually, each one could become a large business. Collectively, they could completely change how Tesla is valued. The value of Robotaxi isn't another car sale, it's recurring transportation revenue. The value of energy storage keeps rising as AI data centers demand enormous amounts of reliable power. And Optimus may become the most underappreciated opportunity in Tesla's entire portfolio. So, what exactly is the trap? The trap is confusing volatility with failure. The stock falls, the narrative turns negative. The bears become more confident. Media focuses on capex spike, margin pressure. Analysts debate how long investors will wait for Robotaxi and Optimus to show up the numbers. But meanwhile, the underlying business keep crossing major milestones. That's how a bear trap forms. And I've seen some of the biggest bulls being trapped into it. Every growth company eventually experiences periods like this. These pullbacks test conviction. They reveal whether investors understand the business they own or whether they were simply following the momentum. Let's finish with one final thought. Back in 2023, Tesla traded at around 101. At the time, buying Tesla looked like a mistake. The headlines were negative, the critics were loud, and the fear was everywhere. Today, Tesla sits above 300. And that's the part investors always forget. The biggest returns always look like a mistake at the time. So now the question becomes, are you accumulating or are you waiting? Let me know down in the comments below. And if you enjoyed this deep dive into Tesla, AI, robotics, and the companies which shape the future, subscribe to Smart Tech Investing. And I'll see you in the next one.